Welcome to Fireside Chat with Mr. Prasanna Balachander, Group Head, Global Markets, Sales, Trading and Research, ICICI Bank. Welcome, Prasanna. Lots of uncertainty around, the U.S. Federal Reserve commentary was more hawkish than market expectations, and dot plot now suggesting two rate hikes by 2023 as against market expectation of one hike. The market reaction accordingly was negative, with U.S. 10-year benchmark moving up by nearly 6 to 7 basis points. In the near term, where do you see the yield on U.S. 10 government security benchmark?
So, Gitu, actually, there was a very interesting movement on the bond yields that actually confounded market followers. Yields had actually initially moved up from 150 to 160 thereabouts, but after that, it has actually been falling and even fell to even less than 1.45 at some point of time. So, basically, what's happening in the US is there has been a twist in the US yield curve post the Fed announcement, with the 2-year yields actually going up by 11 basis points. 5-year yield going up by less than 10 basis points, the 10-year yield possibly going lower marginally, and the 30-year yield actually getting lower by as much as 12 basis points. Now, so of course, these are very volatile times, and what I'm saying right now is at the time of recording, it all depends upon when the viewers are actually going to see this. But nevertheless, there has been a twist in the yield curve with differing reactions across different parts of the curve. And the fall in the long bond yields, when you actually expect yields to go up, is actually epitomized by the 30-year bond yield's dramatic fall by 12 basis points. And this is what has confounded the followers a bit. Now, what is happening is really that the long bond yields are actually driven by a change in the inflation expectations, with the Fed actually getting more hawkish. Now, break-even inflation expectations, which is actually the difference between nominal yields and the real yields, which is derived from tips, has actually come off by close to 10 basis points, which basically means that the market has got much more confident that the Fed will not let inflation go ugly over the longer term, and hence the yields are actually coming off. Whereas the short-end yields are actually reacting to the expectations or the possibility of the Fed actually hiking rates in 2022 or 2023, as against the earlier expectations of no hike till 2024. So having said all of that, I think the market has now digested the Fed. So how US yields are going to go forward is going to be very much data dependent, especially labor data, inflation data, and all those data which will keep coming, and it will come positive as per our view. And as the data keeps coming stronger, we do expect US yields to again gradually start inching up towards 1.65 thereabouts on the 10-year, and maybe even go towards 1.8 towards the year.
Prasanna, Chairman Powell indicated that recent elevated inflation could be more than transitory. So while a rate hike is still some time away, when do you expect the Fed to really start tapering asset purchases? And could it be as early as next couple of months? And what kind of impact would it have on the global and the emerging market bonds?
Yeah. So there are Geeta, there are actually two questions here. First is when does he taper, and second is what happens to bonds. So if you have to address the when does he taper part first, the Fed chairman actually made a statement in the post-policy conference when he said, talking about taper has actually performed its purpose, and let's bury that language. So this basically means that the double derivative is out. He was actually saying that we have already started talking about taper. So let's just bury that language. So now I feel that the next step is for them to possibly mention about the need for taper in the Jackson Hole conference, which happens sometime next month. And after that, possibly in the September to December policy meeting, they will give out the actual plan of how they will taper. And the actual tapering itself is possibly going to start in either December or January. Now, I expect the pace of taper to be around 15 billion per month now. This itself has actually gone up in the last, say, a few weeks or last week or so post the Fed meeting. Earlier, we were expecting 15 billion per policy, which is basically once in 2 months. So this increase in the taper size actually enables them to finish the tapering to around zero by Q4 of calendar year 2022, so that it gives the flexibility for the Fed to kind of, if need be, do a hike in interest rates towards the end of next year. I mean, if need be, if the data really comes much stronger than what is expected. So that's the taper timetable. Now, as far as impact on bonds is concerned, so I've already spoken about the impact on the US Treasury going towards 180, 165 first and then 185. As far as the rest of the world is concerned, the EM bonds in India is concerned, it should be noted that we have actually not seen much of bond inflow so far in the last 1 or 2 years, except to some extent into Indonesian bonds as far as the Asian space is concerned. So the risk of bond outflows, which is what people normally fear when a taper tantrum happens, is much less of a concern this time around. However, equity outflows are definitely a possibility, but of course, that's a textbook response, and most of the time markets don't conform to textbook responses. So my take as far as the bond deals are concerned is it's going to be much less much less impactful taper than what it was in 2013, which is the last time we all saw it, because of the fact that it is now very well telegraphed. The very fact that you and I are talking at length about taper, and we have all been speaking about it last 3 months, means that it has been well telegraphed. And the risks of what a taper can do to global markets, asset classes, people have already gone through it in 2013. And so it's quite, kind of the path is very clear about what can potentially happen, in which case everybody has kind of, learned from their mistakes. And ironically, another important last point I wanted to make is because of the COVID scare being a health scare which kind of affects all countries, there is likely to be greater coordination between all central banks in the world, especially between EMs and DMs also. And not to say that EMs will actually, indicate when taper should happen, but I think they will have a bigger say. And so if things were to get unruly, I'm sure the Fed will be there to manage it.
A change in guidance provided by the Federal Reserve appears to be in contrast to the communication provided by the European Central Bank and other emerging market central banks in Asia. Will divergence in growth pattern between the US and non-US also show up in the monetary policy responses by different central banks?
Yeah, so the first thing that we need to recognize is that there is a reasonably good divergence on the growth prospects between the US and the rest of the world.
Yes.
So while the US is expected to, grow at around 7% this calendar year, the entire emerging market space itself is expected to grow only at around 6.8%, which is actually lesser than the US growth rate. And I frankly don't remember when this actually happened, that the US actually grew more or higher at more than the EM growth rate. Even the euro area is expected to grow only at around 4% this calendar year. So when this kind of a divergence exists in growth, obviously there will be divergence on the monetary policy front, and it is justified. And we cannot really, wish away that aspect. So it does really look that the dollar will probably strengthen due to the differing pace at which policy accommodation is likely to be withdrawn. But the irony is also that, I mean, we are talking about economics, we are talking about how people will react, right? So the irony is also that as the dollar strengthens, let's say the yield differentials between where German bonds are trading and where US treasuries are trading, that yield differential expands. That itself will result in financial conditions tightening too much in the US. And then the Fed will have no option but to prevent too much of tightening, to go slow on the, the hawkishness. There is a very strong, I should say, a feedback loop between inflation expectations as derived from the market and the policy itself. So I think all of this will ensure that while they continue their path on the hawkishness and start hiking or start tapering, they will be very mindful about where dollar is moving and where US yields are moving with respect to where other currency rates are moving. So the short answer to you is the Fed cannot really go hammer and tongs as far as hawkishness and monetary policy is concerned. They will have to take into account what's happening in the rest of the world.
If that's the case, what is the outlook for the global forex markets then? Will the USD benefit from uniformly against all developed markets and emerging markets?
Yes, Gitu. I think the short answer to that question is again unequivocal and an emphatic yes. I think dollar it will benefit the dollar. The view on the dollar does get stronger due to the Fed's hiking earlier than expected, and also due to inflation expectations coming down in the longer end. But currencies, at the end of the day, like I said, is a relative world. And a lot of the view on what happens to the dollar will also rest on how the other developed market central banks behave, especially the ECB and the BOE, how they react, and whether they quicken their pace of tightening or whether they go easy for some more time. As of now, it looks like ECB's easy monetary policies are going to continue, and the European Union growth will be a little bit subdued. Yes, it will grow, but subdued when compared to where the US is growing. And hence, this will keep the bias on the dollar towards the upside. And we expect the dollar index to kind of graduate towards 94 or thereabouts in the next 3 months' time. But like I said, please note that other central banks have effectively been put on notice. And so we have to constantly figure out what is the relativity between the two central banks in terms of various central banks in terms of hawkishness and all that. So the simple answer to your question again is that as long as the growth differential between the US and the rest of the world is on the higher side, the dollar strength will continue. With the caveat, of course, it depends upon how the rest of the world tweak their policies as the Fed goes along. Now, that's, I think, the view with respect to the dollar, with respect to the other currencies in the G3 area. As far as our own currency is concerned, I'm sure viewers will be more interested in what happened to INR.
Yes.
So, on INR, we have a depreciating bias in the next 3 months. And broadly, just a couple of reasons for that. First reason is that we have a widening current account deficit. And this is happening both due to higher non-oil imports as we go along, which will happen due to better growth prospects consequent to the opening up of the economy. And it is also happening because of an increase in oil imports, which in turn is happening due to the price increase, number one, and also because of increase in volumes when the economy opens up. That's the first reason. Now, the second reason, if you really look at it, Gitu, is we spoke about the current account deficit. The second reason is the moderating capital account. And that again is coming from the hawkish Fed, which will impact EM flows in general. I'm not necessarily saying there'll be outflows, but there could be much, much lower inflows. And as far as India is concerned, with inflation coming so higher, maybe we'll talk about it a little later, but with inflation coming so higher, the higher negative real rates in India also will be a deterrent for capital flows into India. So net, the demand supply situation for the dollar is getting positive versus the rupee. And hence we see the rupee weakening to something around 75 or just weaker than 75 in the next 3 months.
Prasanna, you just spoke about that this time the impact of on the bond markets will not be as sharp as that we saw in 2013. So as the markets are all prepared and the reaction of various asset classes accordingly, what kind of impact do you see of all this happening on the Indian equity and the bond market? You spoke about that the yields in Indian bond markets have been stable. There has not been much movement on the Indian bond side. So will the Indian bond market be spared by the continuation of the GSAP program of the RBI and recent developments by bond auction?
Right. Like we have already discussed on the fact that the tapering per se is a well telegraphed, well expected event in the market. And the fact that the Fed has actually made the first fired the first salvo a week ago, and has been reasonably well negotiated by the market without any major hiccups. That's how I would define it. Now, as far as India is concerned, so obviously people talk about the 2013 taper tantrum and what can happen to Indian bonds, how is the macro and so on and so forth. So there is a lot of fundamental differences between how our macro was faring in 2013 and how it is now. Now, reserves are much higher right now, in excess of $600 billion, you will very well know. While last time around in 2013, it was closer to $300 billion. And looking at it also from an import cover perspective, we are almost at more than 15 months import cover now than the 8 months cover that existed in 2013. Then you look at current account deficit itself. prior to 2013, we were actually a deficit of 4.8% of GDP, which is a very high number. And that was one of the reasons why we got classified as the fragile five along with the four other countries. Today, we actually have a current account surplus. The last year was a current account surplus of close to 1% of GDP. And going forward this year, there will be a deficit, but it will be somewhere in the region of 1% of GDP, nowhere near the kind of deficit we saw in 2013. CPI inflation close to 10% then, right now 6%. On the higher side, yes, but not as high as what it was. And the most important thing which will affect the bond yields and the impact on bond is also the fact that the debt holding by FPIs as a percentage of GDP is much lower this time around than what it was last time. This is primarily due to the fact that last 2 or 3 years, we have actually been seeing debt outflows and not inflows. Whereas prior to 2013, there was a lot of inflows into bond markets. So this, of course, is the background. So because of this, what I can confidently say is that this time around, I can say RBI has bought itself a lot of independence by the strength of its FX reserves. They need not raise rates for defending the rupee as much as what they had to do in 2013 last time around. And hence, RBI can kind of normalize at their own pace to some extent and not really match every move by the Fed in terms of increase in rates and so on and so forth. So the RBI intervention can actually prevent the INR from depreciating much. But my sense is that they will depreciate it at least as much as what our EM Asia countries depreciate by, and leave it at that to ensure that competitiveness does not go away. So to sum it up all, I do feel bond deals will go up in India as well. Maybe we can discuss it a little bit later, but it will not have the kind of impact that we saw in 2013 due to all the reasons that I mentioned on the macro.
If we talk about the US interest rates, they have been on the one-way decline since 1981, with US 10-year government security yield declining from around 16% to 1% recently. Do you think we could witness a bigger reversal of rate cycle? Or put it differently, what is the larger trend that you see for the US benchmarks?
So this actually is a very, very good question, Geeto. There are no easy answers for this. If you actually see the long-term trajectory of the 10-year bond yield in the US, every subsequent peak in interest rate cycle has actually been lower than the previous peak. And this is, I think, something that is bound to happen this time as well. By fast forwarding the hike and the taper peak, the market is, I think, right now getting around to the view that the Fed is likely to be ahead of the curve rather than behind the curve. And that's a big relief because that was a big fear earlier. And the fear was that if they were behind the curve, in order to support the post-COVID economy is why they are behind the curve and they don't hike as much as what they should be hiking, then they will have to hike much more later on. So earlier, there was a fear that the terminal rate in this cycle might be close to 2.5% to 3%, 2.5% to 275. But with the hawkishness and with the earlier than expected hike and taper talk and so on and so forth, the market is possibly now coming around to the view that the terminal rate might be 2 to 2.25 at worst. So the behavior of the 10-year bond and the 30-year bond is also reflecting this thought process. The other interesting thing is that they have actually brought forward the rate hikes substantially, but they have not really revised inflation expectations higher. They have actually revised it higher only by 10 basis points. This actually means that the Fed is assuming that the higher inflation in the current year is likely to recede faster once the supply side bottlenecks get relaxed. And they're not looking at average inflation over a period of time. Earlier, the feeling was that they will let inflation remain higher for a longer period of time. And that's one of the reasons why they will have to come back and hike rates much more later on. Now that they have indicated that they will hike even when they are expecting inflation at 2.1 or very close to 2, means that the sanctity of the 2% inflation target is very much there. And I think the Fed has, I think, bought some amount of credibility. So having said all this, I really do feel that this time around, with the Fed rate probably peaking out at 2 to 2.25, I don't think US bond deals are going to cross 2.5 to 3% meaningfully this time around as well.
As you said, U.S. Federal Reserve has indicated first hike by the end of 2023. When do you think the RBI is likely to indicate the similar rate hike cycle guidance? Have the minutes of the June policy meeting provided some kind of a guidance on whether inflation concerns within the MPC are increasing?
Gitu, the April and June policy and minutes were actually mirror images of each other. I'm talking about the Reserve Bank policy in April and the one which happened in June. So if you remember the April policy, it was not very dovish, but the minutes of the April policy, which came out a couple of weeks later, was way more dovish than what it was in the policy day. Possibly because the second wave had, picked up speed in between the 2 dates. The June policy, on the other hand, was actually very dovish, but the minutes which came out around 3-4 days ago, I would say, was much less dovish. So when the June monetary policy happened, the immediately preceding inflation data was for April, which had actually come in much lower than expected at 4.3%. Yes. And this has resulted in a lot of bullishness, dovishness, and the governor even commenting that the inflation reading has opened up some elbow room from a liquidity easing perspective. However, the minutes which came out indicated that even at that level of inflation, which was 4.3% at that time, there were concerns which were expressed by a few members in the Monetary Policy Committee, especially the independent members and also Mr. Mridul Sagar from Reserve Bank of India. Now, post-April, April was at least 4.3. Now, post-April, we have seen May inflation coming in at 6.3. And not only is the Y-on-Y number high, but the month-on-month momentum indicator of inflation is also on the higher side. So the headline is also on the higher side, and the core inflation is also on the higher side. And we expect the next month's inflation also to be 6% or above 6%. So it is quite possible that the incoming monetary policy actually makes some more members switch camps and start expressing concerns on inflation. So incoming monetary policy will not be dovish, and there will be concerns expressed on normalization of the policy. So what they are likely to say in August is that they're probably going to say that they'll be careful of infusing liquidity going forward, but they might still sound accommodative because they still need the growth revival to be intact. They will sound more confident on growth, but they will also show concern on inflation. Now, in terms of sequencing of what RBI is expected to do, which is I think what your question was in terms of how they will go about normalizing. I think in August RBI could introduce the variable rate reverse repo auction for 28 to 56 days, slightly longer than 14-day period to suck out liquidity, where they are currently restricting it to 2 lakh crores. Either that or they will announce a much higher amount for 14-day VRRs. And with inflation still above 6%, they could really prepare the markets for a December to February hike. If no third wave comes, I mean, like obviously the risk is of a third wave right now, then you could actually see the RBI hiking in the December to February period. There could be some descent, hiking the reverse repo rate, not the repo rate. And there could be some talk about changing the stance as well. What we expect is by February to April is when the RBI will formally change the stance to neutral. And of course, following that, basically in FY23 in the second quarter or third quarter is when we could possibly see the first repo rate hike.
If that's the case, Prasanna, what happens to the Indian corporate bond market, which has benefited from RBI's accommodative policy and surplus liquidity conditions? What fallout do you see of this conditions which are emerging on the Indian corporate bond market?
So the RBI had taken a lot of positive steps for corporate bond markets through TLTRO schemes and a lot of similar schemes like HTM benefits and all that, which actually led to a lot of spread compression in the corporate bond market over the last 1 year. Like, for example, you can say a 10-year AAA PSU bond spreads would have come down from around 65 basis points to around 35 to 40 basis points now in the last 1 year. However, there are certain risks very much on the horizon right now. The higher central government and the state government borrowings is always a problem for the corporate bond markets, and they have a tendency to crowd out corporate issuers. with very high liquidity in the past. It is not actually crowded out because there is so much of liquidity, abundant of liquidity. But with now, with expectations of rates going up gradually, liquidity getting sucked out gradually, we could see that crowding out effect playing its path a little. And since spreads are currently so low, there are several investor segments who might actually be constituting, who might be considering to, replace AAA rated corporate bonds with higher yielding state development loans or any other illiquid G-Secs. So that is another risk factor that I think we should look at it. So given the prevailing surplus liquidity scenario currently, I think several PSUs and large corporates are actually preferring bank financing over market borrowings, and they have not really come and borrowed much in this quarter.
Yes.
But once the interest rate cycle, reverses, we may see the borrowers migrating from bank finance back into the bond markets, and that will be coming at a time when interest rates are just looking to go up, liquidity is just looking to, getting sucked out. So that will have negative implications for bond spreads, and there might be some expansion of the corporate bond spreads.
The RBI has sterilized its intervention via the forward markets on a regular basis over the last year or so. Do you see any change in the manner in which the RBI controls its fairly sizable forward book that might directly work to influence forward premium movement?
Yeah, so prior to May, Gitu, I think it was a regular feature for RBI to intervene in the spot market to prevent the appreciation of the INR, and then simultaneously, sterilize the liquidity by paying in the forwards market and postponing the liquidity infusion to a future date. But what happened because of this was the forward premium kept staying high because RBI kept on paying. Because it kept high, it was militating against the easy money policy followed by the Reserve Bank, because the premium itself was much more attractive to receive than even domestic money market yields, and the foreign portfolio investors were simply receiving premium rather than investing in bonds. This was one of the reasons why we did not see any inflows into bonds in the last 2 years. In May, we have seen some change in RBI's forward management strategy, wherein they actually took delivery of the forward that was maturing in their books rather than rolling it over. And this meant that they were not paying anymore, and hence it led to a fall in the forward yields. But we should remember that by doing this, they are actually infusing rupee liquidity into the system. At that point in May, RBI was comfortable doing it because the April inflation had come to 4.3%, like I had mentioned, and the MPC members were comfortable about it. But subsequently, now that we have seen inflation coming in at 6 higher than 6%, now RBI is not going to be comfortable infusing more and more liquidity and taking delivery of the forward book. So I think now RBI will come back and start rolling their forward book again, which basically means that they will come back into paying forwards, and hence forwards might not soften too much from the current levels. I think that is where we are with respect to the forward book.
So what happens if US 10-year Treasury yield moves towards 2 percentage point? Do you think we need to be prepared for a much higher level on the Indian benchmark, 10-year benchmark? Will the trading environment in the Indian fixed market eventually turn bearish? Will the Indian yield curve flatten or steepen?
So I think, there will definitely be a sentimental impact on the Indian fixed income market if US yields sell off by 50 basis points. Because at 2% means we are at around 1.45, 1.5, so 50 basis points from the current levels. I think a lot depends also on the pace at which it goes up. If it goes up in a jiffy, then you could possibly see a dramatic impact on Indian bond yields. But if it goes up slowly, I think bond yields will not get reacted as much. But global asset managers, they look at effective dollar returns while allocating money to emerging markets. And while domestic investors, they and RBI also, they look at the yield differential between where bonds are trading here and where the bonds are trading there to look at the sustainability of the exchange rate. So if yields go up, Indian yields will also have to go up. There is no, two-way about it. There might not be a one-on-one correlation, but at the end of the day, at the end of the reasonably long period, you would assume that if US yields are going up, Indian yields also will have to go up. But more important for Indian yields is what is RBI going to do, and when is RBI going to take the pedal off its bond buying program. Now it has been buying bonds, especially the 5-year, 10-year, and certain key points on the curve, and it's been protecting the bond yields from going up. So those bond yields are very well protected, especially the 5-year and the 10-year. But there are other parts of the curve, especially the 2-year and the 3-year, where RBI is not active and where market has now started reacting to the hawkishness that is expected to come out of the RBI policy after some time. Market always, thinks ahead, and hence they have already started taking yields up. So while I do expect that the 5-year and the 10-year to remain a little bit stable, I think there will be a flattening of the curve where the short end of the yield curve goes up much more than the longer end, because the longer end is already steep and offers a lot of very good attractive returns for investors, whereas the shorter end is actually hugging the reverse repo rate. We expect the shorter end yields to go up. The long end yields will possibly go up much lesser than what the short end is going up, with the result of which there will be a steepening of the curve. But there will be a bearish steepening of the curve, because we are talking about a period where in some time RBI will have to bite the bullet and start the normalization policy.
So now one last question on equity markets. Now that the central banks are turning a bit hawkish, less dovish, what is that you expect? How do you expect the Indian markets to behave from, say, for next 1 to 2 years? Because much of the resilience has been shown by the markets as of now.
So I think, Geetu, again, a lot of how Indian markets are going to react is going to be dependent on how quick the pace of taper is and how quick money is withdrawn from the global liquidity in the global markets. So my feeling is that, first of all, I think Fed will nurture this aspect very carefully and will not do too much to endanger the very recovery for which they have been, supporting all this long. So they will not do something which will let the global equity markets crash, which in turn will mean financial conditions are tightening, and then the Fed will have to go slow on tightening. So that's the first part. The second part, as far as India is concerned, is that, first of all, the view is that we are very bullish on the Indian economy from a corporate sector perspective. While GDP growth rate, the level of GDP might still be lower than what we were from a pre-COVID trajectory perspective, even 1 year down the line, we do believe that corporates in India, listed and unlisted large corporates, have broadly, repaired their balance sheets from a deleveraging perspective, from productivity efficiency perspective, and we are also seeing the impending revival of the investment cycle. People have started looking at expansion, and most importantly, buying coming back in real estate, and buying coming back even potentially in the auto sector. These two sectors have a lot of ancillary benefits to a lot of other other sectors. So we do believe that Indian economy is going to do very well, driven by the corporate sector, because of which in the listed space, the equity markets, the earnings growth is going to be substantial. Now, as long as the global liquidity pool does not contract very fast, very quickly, I really do feel that beyond initial correction, I think we have run a lot. Maybe there will be corrections which will happen. Beyond that, I think the market will again go back to its appreciating ways, because of the earnings, very good earnings that the companies are going to show. And also, if the US markets continue to go up, because it's a slow rate hike cycle, then I think it's a win-win for both US as well as the rest of the world.
Thank you, Prasanna, for your time. It was a real pleasure speaking to you. Thank you so much.